Right now, as we look at the live market data on this Thursday, November 20th, 2025, Safe and Green Holdings Corp, ticker symbol SGBX, is trading at exactly $8.99 per share. The stock is currently exploding to the upside, registering a massive intraday gain of roughly 48%. This is not just a green day. This is a violent repricing event that has pushed the volume over 31 million shares in just the first few hours of trading. To put that into perspective, the average volume for this stock is significantly lower, meaning we are seeing a liquidity flood that suggests something far more aggressive than simple retail buying is taking place. The price action is vertical, tearing through resistance levels that traders have been watching for weeks, and the volatility has triggered multiple halts, leaving investors scrambling to understand if this is a genuine fundamental shift or a classic liquidity trap. The expectation for Safe and Green Holdings has long been one of skepticism and fatigue. For the better part of the last 2 years, the narrative surrounding this company was anchored in the difficult, often low-margin world of modular construction. Investors expected a slow, grinding path to profitability, riddled with supply chain headaches and the capital-intensive nature of building factories. The general consensus was that this was a show-me story, a company that needed to prove it could scale its construction arm before anyone would take it seriously. However, the reality playing out on the tape today is entirely different. We are not trading a construction company right now. We are trading a complete narrative pivot that has caught the market offside. The reality is that Safe and Green has aggressively shifted its identity through its subsidiary, Olinox, moving away from the capital-heavy burden of pure residential construction and into the high-octane world of decentralized energy, Bitcoin mining infrastructure, and AI-driven data centers. This gap between the sleepy, modular builder expectation and the energy technology reality is what is fueling this explosive move. The market is scrambling to re-rate the equity not based on how many houses they can stack, but on the potential margins of their energy assets. When you look closer at the immediate price action, you can see the footprints of a coordinated squeeze. The stock opens significantly higher, gapping up from the previous close of $6.07, and instead of fading as profit takers stepped in, it accelerated. This is a counterintuitive signal. Usually, when a microcap stock gaps up 40%, you expect a pop and drop scenario, where trapped long-term holders use the liquidity to exit. That is not happening here. Instead, every dip is being bought aggressively, suggesting that short sellers are trapped. We are seeing a phenomenon where the bid-ask spread is widening and the velocity of orders is overwhelming the market makers. This suggests that the float, the actual number of tradable shares available to the public, is effectively locked up. When you have a situation where news of an energy pivot collides with a tight float, the supply of shares simply disappears. Buyers have to pay higher and higher prices to convince anyone to sell, creating this vertical price discovery we are witnessing right now. Let's discuss the elephant in the room, which is the short interest. This is where things get incredibly interesting and somewhat technical. Recent data points from varying brokerage feeds have shown reported short interest figures that look mathematical anomalies, with some feeds showing short interest as a percentage of float exceeding 700%. Now, before you get too excited, we have to address this with a head level. Often, after reverse splits, and SGBX has historically utilized reverse splits to maintain compliance, the data feeds from exchanges can lag, failing to update the float size immediately. This can result in glitch data, where it looks like the entire company is shorted 7 times over. However, even if we dismiss the 700% figure as a data artifact, the underlying truth it points to is valid. This stock is heavily bet against. There is a significant population of traders who have been shorting SGBX since it was trading in the double and triple digits on a split-adjusted basis. They are sitting on massive gains, but they are also complacent. The sudden surge to nearly $9 puts pressure on the maintenance margin of these short positions. If they don't cover now, they risk blowing up their accounts. This creates a feedback loop. As the price rises, borrowing costs skyrocket. We are seeing cost-to-borrow rates spike, making it expensive to hold a short position overnight. This forces shorts to buy back stock not because they like the company, but because they simply cannot afford to stay short. This is the fuel for today's fire. Comment below how many shares of Safe and Green Holdings you currently hold, or if you're sitting on the sidelines waiting for a dip. Do you think this energy pivot is the real deal, or is it just another buzzword salad designed to pump the stock? Understanding the company's core business requires looking past the stock chart. Safe and Green Holdings originally built its reputation on repurposing shipping containers into usable structures. Think modular homes, medical centers, and commercial pop-ups. It's a noble, green concept. Take steel waste and turn it into housing. But the economics of that business are tough. Margins are thin, shipping heavy modules is expensive, and regulatory approvals for modular construction vary wildly from state to state. This sluggish reality is what drove the stock down for so long. But the new driver, the reality that is exceeding expectations today, is the Olenox Energy subsidiary. They realize that they have the capability to build modular boxes, so why not fill them with something more profitable than drywall? They pivoted to filling these containers with Bitcoin mining rigs, battery storage systems, and data processing units. This effectively turns their construction expertise into an infrastructure play for the digital economy. By placing these units at well sites or areas with stranded energy, they can monetize cheap power. This is what the market is buying today. Not a house builder, but a crypto-adjacent energy infrastructure play. Let's analyze the darker side of this trading activity, the short-selling mechanics in detail. Retail investors often scream manipulation whenever a stock drops. But here, we need to look at the fail to deliver, or FTD data. When a stock is as volatile as SGBX, with a float that has been manipulated through splits and spin-offs, it becomes a prime target for market makers to provide liquidity by selling shares they don't technically have yet. If you look at the FTD cycles, you will often see spikes in price corresponding with the mandatory closeout dates where institutions are forced to deliver shares they sold naked weeks prior. Today's action has all the hallmarks of a forced buy-in. The volume is too consistent and too aggressive to be organic retail interest alone. It looks like a computer algorithm is systematically clearing the order book. For you as an investor, this means you need to be extremely careful. Chasing a stock up 48% is dangerous because once the forced buying ends, once the shorts have covered, the buying pressure can evaporate instantly, leaving the price to free fall in an air pocket. If you are holding SGBX or thinking about entering, you need to check the borrow fee rate at your broker. If the fee to borrow shares is rising, say moving from 50% annually to 100% or more, it confirms that supply is tight and the squeeze might have legs. However, if you see the borrow rate dropping while the price rises, it might mean that new shares are flooding the market, perhaps through dilution. Companies like Safe and Green, which have historically burned cash, often use these price spikes to raise capital. They might sell new shares into this rally to pay off debt or fund their new Olenox ventures. This is the double-edged sword of a microcap squeeze. The rising price is great for your portfolio value, but it is also a dinner bell for the company to execute an at-the-market or ATM offering, which dilutes your shares and kills the momentum. You must watch for any SEC filings today or tomorrow regarding shelf offerings. If they announce they are raising cash, the reality will come crashing back down to meet expectations very quickly. Let's talk about the psychology of the pivot trade. We have seen this before in the market. A company in a dying or slow industry announces they are moving into AI or crypto or energy, and the stock goes ballistic. The skepticism, the expectation, is that this is a desperate Hail Mary pass by management to save the share price. The reality we have to assess is whether they actually have the hardware and the contracts to pull it off. In the CEO's recent letters, the tone has been incredibly confident, focusing on the integration of business units and the reduction of debt. They are trying to synthesize their real estate assets with this new energy mandate. If they can actually deploy these containerized data centers and show revenue from them in the next quarterly report, this $9 price tag will look cheap. If, however, this remains a concept on paper, the stock will likely return to the single digits or lower. The market is currently pricing in a perfect execution scenario. There is also a governance aspect here that cannot be ignored. The spin-off of Safe and Green Development Corporation, ticker symbol SGD, created a complex web of assets and liabilities. Investors often get confused between the parent company, SGBX, and the spun-off entity. You need to be clear that SGBX is the holding company that retains the manufacturing capabilities and the Olenox energy thesis. The confusion sometimes helps the stock as investors buy both indiscriminately, but it also adds risk. The intercompany loans and shared services agreements mean that if one entity fails, it could drag the other down. This complexity is often why institutional investors avoid these stocks, leaving them to be battlegrounds for retail traders and predatory hedge funds. Looking at the technicals on the daily chart,